The stock market is closed for the weekend, with Opendoor Technologies Inc. (OPEN) last trading on Friday, December 5, 2025, at a closing price of $7.15, a decline of 43 cents or minus 5.67% for the session, continuing a recent slide. The surface-level read on this substantial drop is simply broad market weakness, particularly in high-growth, rate-sensitive sectors. But the deeper reality is that Opendoor is currently navigating a period of profound operational and strategic retooling, a transition that is creating massive volatility in the stock price as investors wrestle with conflicting long-term narratives. This recent downward pressure, pushing the stock closer to its immediate support levels, isn't just a reaction to a tough housing market. It's a direct response to the market trying to price in the massive dilution risk and execution uncertainty tied to the company's recent strategic moves, all while the persistent specter of short seller activity looms large. The common expectation, especially among retail investors who have driven the stock's significant run-up from its 52-week lows, is that Opendoor's new management, led by its recently appointed CEO, is fundamentally fixing the business. This narrative of Opendoor 2.0, focused heavily on AI-driven pricing and operational efficiency, suggests that the company is on the cusp of conquering its unit economics challenges, positioning itself to capitalize when the housing market eventually thaws. This belief is what fuels the occasional massive spikes we've seen. However, the contrarian, or perhaps simply the more pragmatic view, is that the company is still an intrinsically capital-intensive operation exposed to macroeconomic conditions, specifically high mortgage rates and low transaction volumes, that it simply cannot control. The Q3 2025 earnings report, released in early November, painted this complex picture perfectly. While the company reported revenue of $915 million, which actually came in above the high end of their internal guidance and exceeded some analyst expectations, the bottom line was still a net loss of $90 million, and the adjusted loss per share of minus $0.08 missed the consensus forecast. The sequential decline in revenue and sales volume, and the fact that the company is still clearing out older, lower-margin inventory, highlights the difficulty in smoothly transitioning the model while the core market remains tight. Looking closer at the daily price action and trading volume in the past few weeks, the volatility is impossible to ignore. We saw a considerable upward move following the Q3 report, driven by the revenue beat and the new CEO's aggressive posturing, particularly his comments aimed directly at short sellers. This push was followed by an aggressive pullback, culminating in Friday's near 6% drop on heavy trading volume. The average volume for Opendoor is around 95 million shares, and the recent trading days have frequently seen volume in the range of 40 to 55 million shares, indicating a significant, albeit slightly reduced level of engagement compared to its most volatile periods. This suggests that while retail interest remains elevated, institutional players are still actively trading around the technical levels, contributing to the violent swings in the stock. The technical picture is currently looking precarious, with the stock recently falling below its 15-day moving average, a level that often acts as a short-term psychological support. Should the stock break below the immediate support around the $7 level, which is a major psychological and technical hurdle, it could signal a test of lower levels, likely shaking out some of the weaker hands that bought in on the post-earnings enthusiasm. This brings us to the critical component of short-selling awareness and pressure, which is particularly relevant for Opendoor. The narrative of a potential short squeeze has been a consistent driver for this stock, especially across retail trading communities. The most recent available data shows a substantial short interest hovering around 16.28% of the float, which translates to over 127 million shares sold short as of mid-November. While this percentage is high, it has actually been trending down slightly from the near 27% short interest we saw in early October, suggesting some short positions may have covered during the recent run-up, or that the increase in the share count has diluted the percentage short. However, 16% is still a significant overhang that presents a ceiling on any sustained rally. The days-to-cover ratio is currently around 2.01 days based on the latest figures and average daily volume. A days-to-cover figure over 2 generally suggests it would take a meaningful amount of time for short sellers to fully exit their positions, which is the necessary kind of friction to fuel a short squeeze, though it is not as extreme as some other meme stocks. The short seller's core thesis remains simple. The iBuying model is inherently flawed because it requires massive capital to fund property inventory, exposes the company to rapid changes in housing prices, and structurally struggles to compete with the low cost of traditional real estate agents in a normalized market. The high cost of capital in a rising interest rate environment amplifies these concerns, as it costs Opendoor more to carry the homes on its balance sheet. When new CEO Kaz Nejatian announced the distribution of tradable warrants to shareholders, a move he openly stated was designed to ruin the night of short sellers, it created a temporary surge. The thinking was that short sellers, obliged to provide the warrant distribution to the lender of the borrowed shares, would be forced to buy these warrants or cover their positions, thus driving up the price. While this move was a creative piece of corporate theater, investors must understand the counterpoint. These warrants, with strike prices well above the current market price, combined with the company's ongoing debt-to-equity exchange offers, will ultimately lead to further share dilution. Dilution is the quiet killer of shareholder value, and it's one of the key motives for institutional short firms like Citigroup and others who maintain a cautious or sell rating on the stock. Retail investors need to monitor the off-exchange short volume, which remains high, as well as the borrow cost spikes, which have been relatively low recently, suggesting the supply of shares to short is not yet critically constrained. But any sharp increase in the borrow rate would signal rising short pressure and potentially higher risk for a squeeze. At its core, Opendoor's business model is straightforward, even if its execution is complex. The company acts as a technology-enabled market maker for residential real estate. It makes instant cash offers to homeowners, purchases the homes, performs light repairs, and then resells them. The margin is the difference between the sale price and the all-in cost of acquisition, renovation, and carrying costs. The problem has always been the all-in cost side of the equation, specifically the financial risks associated with holding housing inventory for too long in a fluctuating market, which has historically led to massive write-downs and losses. The new management is attempting to shift the focus to greater pricing accuracy powered by data science and artificial intelligence, hence the Opendoor 2.0 theme, while also emphasizing hybrid products like Cash Plus, which allows sellers to accept a cash offer while still reserving the option to list the property on the open market, thereby diversifying monetization away from the pure iBuying model. The market's patience for this strategic pivot is finite. The macroeconomic pressures are severe. High mortgage rates have effectively locked many existing homeowners into their current homes, severely restricting the housing supply. While this low supply can theoretically lead to higher margins for the homes Opendoor does manage to sell, the low volume of transactions fundamentally limits the company's ability to scale. Management has guided for a Q4 2025 revenue decrease of about 35% sequentially due to low inventory levels, reinforcing the volume challenge. However, they also project an increase at least 35% in home acquisitions for Q4, signaling confidence that their new product and pricing engine changes are starting to take effect. They have reaffirmed a long-term goal of achieving break-even adjusted net income by the end of 2026, which is a major yet distant target. Looking at the future of Opendoor, The situation boils down to a clear set of risks and catalysts. The primary risk is a prolonged high interest rate environment that continues to choke off transaction volume, forcing the company to burn more cash to cover operating losses while awaiting its break-even moment. A secondary risk is the aforementioned share dilution from the warrants and convertible debt exchanges, which spreads future profitability across a larger share count. The main catalyst, on the other hand, is the successful execution of the AI-driven model, proving that Opendoor can maintain consistent, positive contribution margins even in a tight market, combined with a potential easing of interest rates in late 2026, which would instantly flood the market with both supply and demand. The stock's significant beta coefficient of around 2.37 means that any positive shift in the broader housing or interest rate environment